Good morning, everyone. Just giving it a minute for everybody to attend. Thank you very much for attending this webinar. Today, we're going to be doing a different form of webinar. Obviously, as mentioned in the emails, we'll be doing a bit more of a live discussion or questionnaire. I'll be going through quite a few different things, but I'm just going to give it a minute before we really get started, just to see if we can get all registrants attended before we get started. So give it just a minute and I'll get started. All right, so let's just get started. Whenever everybody attends, that'll be great. And if not, whoever misses, all good. So Justin Ishac, Senior Investment Manager here at Sharewise. Thank you very much for attending. Today, we'll be going and covering the FOMC statement, market implications, and I will be answering any of your questions. So live as well. So if you have any questions, you're more than welcome to pop them in the chat. And I'll obviously answer them live. In the meantime, I have had quite a few questions asked by a few registrants while filling out the details, which I'll answer. And I'll just cover as well a couple of main points from the FOMC statement. So firstly, disclaimers out of the way. This is only general advice. We do not provide personal advice. This does not constitute personal advice at all. This is for informational purposes only. Please understand the risks before you invest. And if you'd like further guidance, you can obviously opt to request some assistance at the end of the webinar as well. Okay, so first thing is recently overnight on March 19th, the FOMC decision was to hold interest rates steady, which was good. So this did reduce quite a bit of risk in the market recently. So what was mentioned by Jerome Powell overnight was that while obviously they've held interest rates steady, what they've noticed is there was a reducing of pace of balance sheet runoff, suggesting that the Federal Reserve is leaning toward a more dovish stance despite lingering inflation concerns. So they did highlight a few things. Obviously, a few key takeaways. Rate cuts are still on the table. Okay, while no cuts were made this month, Powell reaffirmed expectations for at least 2 rate cuts in 2025, likely starting in Q3 or Q4. So the other point was that inflation was stickier than expected. So PCE inflation forecast was revised higher to 2.7 from 2.5. Signaling that while inflation is declining, the process is slower than initially thought. So obviously that's something that we know. Inflation has been quite sticky for a while, right? And you know, but recently in the last 12 months, we've seen inflation get well under where it was back in the pandemic, and hopefully we continue down that path. And the next thing they've highlighted is economic growth. So it was a bit of a downgrade. So the Fed's GDP forecast was lowered to 1.7 from 2.1%, suggesting concerns about a potential slowdown. Now, this doesn't mean necessarily a recession, just means that there will be a bit of a slowdown. So, you know, following that, they also mentioned the liquidity boost. So the balance sheet runoff slowdown means less tightening in financial conditions, which can be supportive of risk assets, okay? So a big question that I was asked from one of the registrants was which sector to look at or who benefits, right? So very good question. Look, given the Fed's shift toward looser liquidity conditions, persistent inflationary pressures, certain sectors that stand to benefit more than others are the following. So look, we do still think there is always risk to be concerned about, with the market still being a little bit more volatile. But nonetheless, technology, the NASDAQ and growth stocks, we do still think yield, or will hopefully yield, some of the best results for growth. And that's because of their dovish stance around reducing interest rates Q3, Q4 still, right? Also, lower bond yields. So due to the Fed's dovish shift, basically, we should see this support tech and high growth stocks. So there is a saying that is called TINA, there is no alternative. At the end of the day, guys, investing money in equity markets is really the only place to be if you're looking for growth, right? So given the fact that they have been dovish in their rhetoric, we would still see the potential to look at some of these areas. So companies with high valuations and long-term earnings potential, like AI, cloud, semiconductors, are sensitive to interest rates. So you want to be mindful of that. So any shift to more hawkish statements, you'd be very, not fearful, sorry, you'd be very careful on those sectors. But key stocks to watch would be NVIDIA, Apple, Microsoft, Google, Amazon, these style names. Financials like banks, asset managers, brokerages. A pause in interest rate hikes prevents further margin compression for banks as well, I'll mention. Investment banks and asset managers could see stronger capital market activity if the Fed's dovish stance spurs a risk-on rally. So after this, if we see a risk-on rally come through, we're likely to see asset managers, fund managers potentially outperform as well. So we'd be looking at some of those style plays for we would say the catalyst to this would be obviously a bullish movement in the market. So the market runs, asset managers should do well as well, right? So that's another point I'd like to make. Key stocks to watch in those areas might be JP Morgan, Goldman Sachs as an example as well, okay? Real estate, REITs, they should also benefit. So that's also a sector we do cover. So one of the main areas we would look for is quality REITs in sectors that are poised for growth for real estate. So for example, you'd be probably looking at more in the like of residential or even commercial REITs as well. Slower tightening balance sheet supports real estate valuations by keeping mortgage rates from increasing too fast, therefore increasing liquidity, more borrowing power, higher prices coming through, right? So we do think this could also be an area to really look at. And we've got a few stocks that we do recommend on the REIT space that if you do want to have a look at, we can discuss as well. So key stocks as an example here might be VNQ to look at as well, right? So again, ladies and gentlemen, any other live questions, you can pop in the chat box or the questions box. You're welcome to ask. All right. Okay. Next question that I had from a registrant was which sectors to be careful of. So consumer staples, right? You might just want to be mindful. They're not really to be careful in the sense that they'll sell off, but I don't see too much growth come through here at the moment from what we're seeing. So these sectors typically underperform when risk appetite increases. So if we do see a reversal back to the upside and there is a risk on rally coming through, you'll see these sectors underperform, okay? So you could rotate out of some defensives and look at some high risk or high beta plays if rate cuts become more likely in the near future. Energy and commodities. So we do like energy. We do think that energy is a good play at the moment. So while oil prices remain strong due to geopolitical risks, Ukraine war, Mideast tensions, the signal that the Fed gave around slower GDP outlook suggests maybe a bit of a lighter demand. So we wouldn't be too heavy in this sector either, right? But we'd still keep some exposure. The point here is you just want to be mindful and maybe just consider not being too heavyweight to the space. Okay, so if you listened in some other webinars, we've been buying ExxonMobil. That's been a really good play for clients. It's done really well, trading at a really good level at the moment. So you might just want to be mindful of that. Could potentially look at locking in some profits soon or reducing some risk. So another big main question that I was asked was, recent market sell-off, was this a dip to buy, right? Is this the time to be buying in low? So I think it's important to understand what triggered the sell-off before we really dive in there. So what triggered the sell-off is a few things. So high inflation prints in Fed in March, right? So basically those inflationary prints were a little bit hotter than expected, and they did spook investors into pricing in more hawkish rhetoric from the Fed. So that was one of the main reasons. Geopolitical concerns, Russia, China, trade wars, Trump, the Trump administration essentially initiating more tariffs, the bond market volatility weighed on sentiment as well. So there was quite a few main areas in these sections that really drove a little bit more of a risk-off approach that caused a bit more of a negative sentiment to markets. The S&P pulled back about 9% roughly, and the Nasdaq around the same as well from the highs due to this. So is this an opportunity? Well, the answer that I mentioned in the previous webinar was yes, right? So selectively. So you don't want to go dive all in, but this could be a significant buying opportunity. So the combination of more dovish commentary from the Fed, resilient economic growth still, and solid earnings momentum suggests that this correction could be a buying opportunity for long-term investors, which is what I mentioned on the previous webinar as well. Obviously, understanding there will still be volatility and there could still be a bit of downside still. But the reasons that I've put together here to potentially buy the dip, I think, are really important. So firstly, the Fed is shifting toward rate cuts later in the year, which historically boosts equities, especially tech and growth names. 2, bond yields peaked in early March and have started to decline, easing pressure on equity valuations. 3, market positioning had become overly bearish, leading to a potential short covering rally if sentiment improves. So given that we saw a nice bounce on the Nasdaq last night and the S&P, I think this is a key support level at the moment in the near term. We do need more confirmation. We need some more follow through, and hopefully we get that tonight. Okay. Tech and AI driven companies continue to deliver strong earnings still, given the market pullback. So this is justifying their long-term valuations as well. So I guess in a nutshell, this could be a significant buying opportunity. Generally speaking, taking a bit more of a middle ground will serve you a lot better than not being invested. I'll put it that way. If you attended my webinar the other week, I mentioned that basically the market does seasonal movements quite regularly, and it's not always an indication of a bear market, right? And I mentioned that it could be a significant buy opportunity. And if the Fed does come out with more dovish statements this week, we could see a rally if you attended the webinar the other week. And we're seeing a bit of a pullback. We saw a bit of a pullback, and then we saw a bit of a bounce come through in the last trading day or two. So I'm going to share my screen in the near term, shortly, just to show you what I mean. But in the near term, what we're saying is, don't put yourself in a position where you're not allocating capital just because you're too worried. We do believe there could still be some selective opportunities. You just want to be mindful. And if you really want some better entry points, on the advisory side, we could help you sift through all of the concerns and try and get some decent businesses in your portfolio as well, from a general advice perspective. So the best strategy would be gradually accumulate high quality growth stocks and beaten down tech leaders at the moment, would be the general sort of view. Look for relative strength. Focus on stocks that held up well during the sell-off. Use the 200-day moving average as key support level to time entries. And again, on the advisory side, we can help you identify those opportunities. Potential risks to watch for here. So firstly, sticky inflation risk. So if inflation remains high, the Fed may delay rate cuts, keeping pressure on equities. So something to consider. Geopolitical shocks, any escalations in global conflicts could trigger further volatility as well. Earnings disappointment. So if the earnings results come in weaker than expected from the previous quarter as well, markets could see another leg down. So that's something to be very cautious on and mindful of as well. Okay. So are we at a market bottom was another question that I was asked. Very good question. Look, the recent pullback, it appears to be a healthy correction at the moment, okay, rather than the start of a bear market. However, it doesn't mean that we may not be in one, because you could still see downside, right? And you could still see that come. It really does depend on everything I've already mentioned. But it appears as though it's been more of a healthy correction, okay? As I sort of trade in the previous webinar as well, we did think that could still be a bit of a healthy correction. At the same time, it doesn't necessarily mean that that's definite. It does depend on the next week. And again, the next CPI read as well. So as long as economic data remains stable, the Fed stays on track for 25 rate cuts, equity should find support around these levels. Now, the thing is, there is some key levels around 5,000 points, 5,000 as a point range for the S&P, and about 15,000 for the NASDAQ, which is significantly, lower than where it is now, obviously. But the recent market activity overnight after the Fed sort of statements and such shows that we're getting a bit of a positive response to the decision to maintain current interest rates, with major indices experiencing gains. So S&P was up by over 1% last night, the Dow close to 1%, the NASDAQ over 1.4%. So again, we could be seeing support here. And I'm about to share my screen and show you what I mean as well. So all right. So as you can see, hopefully you all can see my screen. Lovely. So as you can see, this is the NASDAQ on the weekly, the NASDAQ composite. Okay. So I've already drawn out some analysis for you to view here, technically. So we're in a very nice bullish channel, as you can see. We've consolidated quite a bit for a few weeks, 1, 2, 3, 4 weeks of consolidation, right? Now, we've hit a nice support level. We've got a bullish candle right here. This is indicating a lot of buy volume coming through. What we want to see on this candle for the week is we really want to try and see if we can recover back towards that 18,000 point range, 18.3, for a weekly close. If we can get that, this is a strong sign of a potential recovery back towards this level on the weekly. Okay, so this is what we really want to see. We want to see this level retested and hopefully close in and around this range. Now, if you look at the daily, obviously the daily indicates that we've been consolidating a little bit here. This is the 200-day moving average, right? So as you can see, we are trending slightly below the 200-day. So what we want is we want to break up above that 200-day moving average and a close in and around there. to give us a strong indication of more upside. Now, the RSI we can see has exited the oversold state, indicating that we're in a more neutral zone. So I really want to see the RSI push up above 51, 52 and continue with that momentum and a rising volume signal as well. So this could be a significant buy opportunity. It really could be, but we do need to see some follow through, right? I just thought I'd share that with you so you guys can see what we mean from that perspective. Also, hopefully you can see this still. Yep. So just wanted to point out overnight the outperforming sectors so you can see what I mean. Tech was definitely one of the major sectors that outperformed overnight, right? Electronic tech, health tech, not so much, but electronic tech and technology services. So what that's indicating here is basically, as I mentioned, we could still see a nice support level come through in these areas. So this upward momentum, it does suggest that the market is currently finding support at these levels. So well above the critical support zones that I mentioned before. So obviously for the NASDAQ, we're talking about 15,000 points. So that would be in and around these areas, are heavily supported areas. Now that doesn't mean that we're going to drop that low. I'm just sort of letting you know what I'm seeing here, okay? So we need to seriously hold up here and reverse in order to maintain a bullish structure. If we break here, we could see more downside, but hopefully not. And it looks like we're getting support at the moment. So in summary, the market volatility has been strong and we've seen a bit of a bounce back come through. We do need some follow through and let's hope we get that. So the next question I've gotten here was, here we go. So next question was, here we go, short term, medium term, and long term. So give us some updates on what you see for the market. So, well, market volatility in the short term, dip buying opportunities are emerging. Medium term, I'd expect a recovery in tech, growth stocks, and financials as rate cut expectations increase. That comes through. Long term, AI-driven sector could be in play, and a nice bull market remaining intact, favoring tech indexes or indices like the NASDAQ. Okay, so those are some key things I would suggest for the short term, medium term, and long term. Thank you, ladies and gentlemen. So look, I'm just going to launch a poll. And while I do that, I hope you guys have enjoyed this webinar. Again, if you have any questions, please ask away. So I'm going to launch that poll. While I do that, I will just go through, again, a couple of key things here on the on the screen. There we go, beautiful. So as you can see, that's the NASDAQ. I didn't show the S&P, so I just wanted to give you some insights on that as well, right? So we've got, you can see here at the moment on the S&P, we're actually at this critical level. We're at that 200-day moving average right here on the S&P. We've just slightly broken above this. So right now, from what I'm seeing, we could see a nice continuation come through, right? So what we're hoping for is a continuation towards that 6,100 point range. We do need it to close above the 200-day moving average. And then if you look at the weekly at the moment, we're still well above that, right? We're still well above that on the weekly. So if this candle, right, this is called an engulfing bullish candle. But if we can close in and around this level, that's an indication of a nice reversal. All right. So at the moment, we do still remain bullish. We do think this could be an opportunity to buy. And you just want to be mindful that there will be risks still, and to be mindful of the FOMC statement is one thing, but the next inflation rate read through is going to be important. So also Trump tariffs and how that plays through as well. Who knows? What if Trump reduces his tariffs again, right? You never know. Could see another run come through in the market, even more than what happened in 24, right? So at the end of the day, point here is, I hope that's answered a lot of your questions. Thank you so much for attending this webinar, ladies and gentlemen, and hopefully I'll be in touch with you at the end of the webinar as well. I'm going to end the poll. And any questions, again, you're more than welcome to ask through. And thank you so much. Hopefully we'll talk at the end of the webinar, and have a wonderful day. Take care.